Howdy there, folks. We got a buy one, get two free here in this one. First video for me to react to in this one. I don't know what these guys at Fund Strats drink. Short Hills Capital, Steve Weiss. Oh my gosh, okay. Fund Strat, if you don't know, Tom Lee, okay, and I know we've reacted to Tom Lee several times in this channel history, so by now you guys should know Tom Lee very well. That's interesting, so we'll get into that one in this one, okay. Chart Master on what's next for the markets after the volatile week. So we'll hear what the Chart Master has to say, and I'll give my 2 cents on what's up next here for the market. In last video up here that I think should be interesting to react to is I think we're starting to see all the Fed's work to come to fruition, says Morgan Stanley's gentleman here, okay, who I actually haven't seen on CNBC before, so this should be interesting to kind of hear his playbook. I don't know if he's about to get into some high net worth individuals and what they're up to in the market. Something I have seen that's interesting, right, is look at the moves in big tech, right? Look at the big moves in those stocks this past week. That smells like big money, just to be quite frank, because I can tell you with those stocks making some of the moves they made this past week, you're not getting those stocks to make those sorts of moves without some real big money pumping in and moving those stocks that have hundreds of billions of dollars of market cap, right? Some even $1 trillion plus, multi-trillion dollar market caps up the way they did, unless you're going to get some big money infused kind of into the market to push those babies. So, yeah, appreciate everybody. As always, 24,700 plus subscribers. Also, thank you everybody that supports this channel on Patreon. If you haven't joined us on Patreon, get in there. It's awesome. I just posted the stocks I bought in Patreon like literally a few hours ago. So if you want to see those as well as all my future moves, check us out on Patreon. It's $10 to join there. It's a no-brainer. Get in there, man. It's pinned comment. Alrighty, guys. Hope you enjoy this. Let's get into it.
You guys from Fundstrat's Mark Newton. He put out a note today saying tech saves the day again. He believes the lows for this March decline were likely made on Monday. He believes that the S&P gets back up to 4025 the next couple weeks. And he says technology might very well continue up without any meaningful consolidation, at least in the near term. Weiss, you're making a face. You're looking at it.
I don't know what these guys at Fundstrat drink. What do they do? What planet are they living on? You know, we've heard the bullish call for a couple of years now. When the market's going down,
that far away.
Okay, but it's not that far. But look, I don't think the bottom's been put in, right? That's the primary call. The bottom's put in. No, it hasn't been put in. Okay, and as far as tech goes, I mean, it's a momentum trade. It's purely a momentum trade. You can't tell me the fundamentals of Microsoft are better today than they were a month ago. They're actually not, okay? So you're still seeing the economy slowing. You're seeing cloud slowing. You're seeing data centers slow. So it's just people looking to hide. When you hide in a place, right, you're the first to come out when it starts going down. So I wouldn't put new money in there. Having said that, I did buy some more Google this week, right? And it's a trade. And I'll keep some of it for the long term because if you look 2 years from now, 3 years from now, stocks will be higher than where they are now. It's just a question of putting it.
But Weiss, I want to push
2 years, 3 years higher than now. Here's the main issue I see with this gentleman, okay? Short Hills Capital here. He's so convinced the bottom's not in for the market, meaning we're going to make a new low that's lower than what happened in October, right? And I'm just going to tell you, you can't predict that sorts of stuff. You can't predict that, you know, October 13th or whatever it was, the market was going to hit a low, although I think I did do that on the channel. But no, in all seriousness, you can't predict that stuff, right? And so the fact that this, you know, Steve Weiss gentleman's like, oh, you know, it's ridiculous, like the lows still to come in this market. It could be. It might also not. Like, you can't predict it like that. Like, no one ever does that, right? And so I just think, you know, thinking you're that smart that you know exactly when the market's going to bottom and that we're going to hit this price and that's going to be the time to buy. It's a mistake. And the worst part is if it happens and you're right, because then you think you're going to continue to be right with making those outlandish calls, and no one can do that properly. No one.
The S&P's at 3920. He says it gets up to 4025 the next couple of weeks, 100 points in a few weeks. And you're saying he's drinking
said the bottom's in. The bottom's in. Read that. You said
I did. I read it. But I mean,
so the bottom's not in, is my point. I think you drink Kool-Aid. You know, well, they drank Kool-Aid at Jim Jones's retreat as well, and that didn't work out so well.
It's a metaphor.
So it's an optimistic Kool-Aid.
Okay, so first of all, on the mega caps, they are the best banks in the world right now.
Yep.
And that's really a part of the fundamental story where you're seeing a lot of return to capital back into them. The mega cap put, we learned that's what's in place this week. It's not the Fed put, it's the mega cap put. Now, let me share the ugly part of it. The ugly part of it is I don't own any of them. The ugly part of it is the strategy, the quality momentum strategy that's publicly traded doesn't own any of them They liquidated them in the fourth quarter of 2021. To your point on momentum, momentum as a factor is down 9% year to date, okay? Momentum came completely out of all those mega caps. And a lot of the non-discretionary funds followed along with that, and that's where the consensus playbook came into play in 2023, where no one owned them. And right now...
But do you regret that? Do you regret it?
Well, I mean, when you look at performance, of course you regret it, but you don't regret following your strategy over the long term. You have a rules-based strategy and you follow it. When you look at where you are right now, Frank, of course, obviously, you look at performance, you say, yeah, I wish I was there. But it allows you to understand what's going on in the market right now and have the humbleness to respect that right now, there's really no strategy that's working because all of that consensus, even the consensus that there was going to be a strong economy and a soft landing, that is getting obliterated. That's where the capitulation is ultimately happening. And you're seeing those funds flow back into mega cap. They're the best banks around. Does it continue? That's the question. And candidly, I don't think anyone knows the answer to that.
Interesting thoughts there, right? And basically, you know what argument that man just made? You know, I was trying to figure that out as I was watching that. He made the argument of basically just taking advantage of deals in the market. And, you know, to try to predict like that Steve Weiss is doing, oh, you know, we haven't hit the lows yet. We're going to hit some new low, right? And trying to put these calls out there that a lot of people have been doing, oh, S&P's going to 3,400, 3,200, 3,000, whatever, right? And everybody likes to try to make these calls and just like almost all of them are wrong. Like literally almost all of them are wrong. And, you know, somebody ends up being right in the whole situation, right? But it's just like most of the time it's wrong, right? And so at the end of the day, you see great opportunities in the market. You got to pounce. You got to work with urgency in this market. You don't work with urgency in this market and take advantage of the deals that are presented to you. You look back with regret over time. As I could see it in those guys' face, they're regretting because they weren't taking advantage of the great deals that were out there, right? Many of these Wall Streeters weren't. They weren't taking advantage of Meta under 100. They weren't taking advantage of Tesla at 100. They weren't taking advantage of NVIDIA at 110. And we're just talking about where these stocks were just a few months ago, right? And now they're looking at these stocks at 50%, 100%, 150%, right? And they're like, how do we get those babies back down again? And then you're kind of like hoping like, oh, the market tanks, everybody sells everything, like... And it's like you already had such a crazy influx of selling pressure that happened last year. I mean, do we forget the NASDAQ fell, 5,000 plus points? That was the entire NASDAQ at tech bubble peak was 5,000. At tech bubble peak, okay? We lost that last year. We lost the entire NASDAQ. Think about that for a moment. Let that marinate on your brain for a little bit there, right? This just goes to show you how much selling pressure there really was last year. It was immense. I mean, the NASDAQ was down, 37% or so? While you had unemployment in the threes? That's a very extraordinary. You don't see that too often, right? But that's the market we went through. And so, nonetheless, man, you've got to work with urgency. You've got to take advantage of the markets. Let's hear what Chartmaster has to say in regards to what this market's up to now.
Master, who's here at the top.
Look at that. Well, when I heard guarantee, you know, I had to. Because that's a big word. But anyway, you know, it's funny. I was looking at something. So today's a Friday, right? And 2 years ago on a Friday, guess what happened? FedEx beat, Nike missed. And we were all sitting here, and guess what the S&P, it is exactly unchanged. It's 13.16 today, it was 13.13 then. The market has made absolutely no progress in 2 years. And while there's been a lot of volatility, I don't think much is coming. I think the offsets, you see this money flow into Apple, into Microsoft, but that's already run its course to some extent. And yet this catatonic, and rightly so, abandonment of banks and financials and energy.
A directionless market. Thank you. That's exactly what I've been preaching for the longest time, right? In terms of trying to get the market, you know, we're kind of stuck in a 3,800 to 4,200 range for the S&P right now. And the reason being is the bulls don't have enough to go off of to really get this market to go bull mode, right? The bears don't have enough right now to go off of to really get this market down substantially, right? You had some bank failures there, but at the end of the day, Fed stepped in, says we're going to back everything. So you don't have it on either side to push this market in a major direction. What could get us into the major direction is one of two scenarios. If you're talking about the bearish side, let's talk about that first. What could we get to tank this market, right? hot inflation, like the inflation doesn't go down, which is very unrealistic at this point in time, so I don't even think that's a very realistic possibility. I think one scenario that could get us down is if mortgage rates and interest rates continue to be very, very high for the remainder of this year, because I think the housing backlog will dwindle to, I don't want to say nothing, but it'll dwindle to very low numbers, and I think we can see a lot of job losses in construction fields and everything in relation to that. And so I think that's, if you're talking about the economy, talking about hurting earnings, hurting unemployment, hurting spending, all those sorts of things, that's a scenario that could play out on the bearish side that could get you under that 3,800, in my opinion. If you're talking about how do we blow through a 4,200 level this year, you need obviously not the economy to fall apart, right? You need a potential of the Fed, maybe even talking about cutting rates because inflation's starting to come down so much that it becomes not really a concern. Or you could get a scenario where essentially earnings come in much stronger throughout the year than what Wall Street's expecting, which is actually what I'm thinking is going to happen. I've been talking about that for a few weeks. I think there's a strong probability that for the biggest of the big dog companies and even a lot of the small companies, they're going to have improving revenues, improving margins, improving net incomes, improving cash flows versus what they had previously. And so that's what I think is going to play out there. We'll see. But that's what could get you to, let's call it back in a bullish mode in the market and to break through that 4,200 and then start talking about, okay, 4,400, 4,600. How do we get back to all-time highs of 4,800 plus? That's how you get there.
But we're just churning. And the thing that let me say this, all my calls with clients, everyone, because their job is to beat the bench, right? As managers, custodians of assets, they're constantly trying to figure out that chess match. But, and you know this as much because you're doing it, sometimes it's very hard to do that. And also this, we all see direction. So think about the market. It's been very directional. From the 18 low all the way up until COVID, we were straight up. And then we went straight down when we crashed. Then we went straight up, government-induced or not, all the way from the COVID low to the highs, and then went straight down. We haven't had a sideways period in a long time. And there are endless periods in history, in the 70s, in the 50s, where you are sideways. And I think that's what this is. And now, either that's the opportunity to pick winners, or it's the opportunity to churn and never quite.
I have a question, though.
Yeah.
1 week ago, or not 1 week ago.
That is just another reason why it is so powerful to learn stock picking, right? And to build out a portfolio of 10 to 20 stocks of your own. Because, something we definitely got, I would say, spoiled with was obviously because the S&P 500 just basically went up almost every single year for like 15 years, 14 years in a row or whatever, right? It was just year after year after year. It seemed like S&P always went up. We got spoiled. A lot of people just, hey, index funds, I can just put my money in an index fund. I don't have to put in any work, any effort. And isn't that beautiful? It's just like guaranteed money, and I get to make all this money. And S&P 500 is up another 15%. I don't even have to put in work, and I make 15% on my money, right? And so everybody got very spoiled with that. What happens if you have, 5-10 years where the S&P 500 doesn't make much of a move? It's up a little bit, it's down a little bit, it's up a little bit, and it's not moving huge either way. It's not crashing, it's not skyrocketing. What do you do in that? I can tell you in that sort of market, it's going to be plenty of companies that do enormously well and their stock prices thrive. You can go back to every period when the market was in chill mode, meaning it's not really going anywhere for a 2, 4, 6, 8 year span. And there will be plenty of companies that thrived during that time and other companies that did not thrive and they did horrible. And that's where being a stock picker and investing for yourself really comes in hand. It's not just about it's fun, and it's not just about like I get to take my own money in my own hands. It's not just about I'm going to try to beat the market. It's about like, what do you do if the market doesn't move for years? It has happened before. What do you do in that scenario? That's why you got to learn this stuff, man. And, I think it's important. Like I said, you know how it is in life, man. The ones that put in the work and the effort, they always end up with the worms at the end of the day.
A week and a half ago, did you also think that we were in for a sideways period before this whole bank meltdown happened?
And that's what the pair two is. I mean, I know it gets so boring. People say, well, you're kind of saying that a lot. Well, because hold means nothing. Hold is a Wall Street euphemism for sell. We don't want to offend people. It is a pair two. It's not a big hand here. There are big hands, and you get risk or reward. Do you step in and buy banks? A lot of people make that case. That's high risk, high reward. But the aggregation, equities is an asset class, as measured by the Russell 3000 or the S&P. They are basically...
I don't know if I agree with his statement about banks are high risk, high reward. I don't know if I agree with that, to be quite frank, especially now that the Fed backstop's in there. 2 weeks ago, maybe you can make that argument. Now, I think it's tougher, actually.
Stock going nowhere. And I think the temptation is always to see direction.
Carter, thank you. We'll see you in a few on options action.
Guaranteed. Guaranteed. You'll see
guaranteed. Grasso, quickly, what do you think about
this?
Yeah,
so I agree, and I felt the same way. I think we're in a trading range. We dipped down to the lower end of that trading range, kind of broke it. 38.15 is a huge level in the S&P. I don't think we have the ability to rally all the way back up to that trading range, which the top of it was 4,200. So just watch that 38.15 level in the S&P to the downside.
You know what's also guaranteed is that the banks are going to report their Q1 earnings. They're going to be the first in the cycle. That's going to be in mid-April. And I just got to think, as much time that these bankers are going to be spending in Washington over the next few weeks, the level of transparency, there is no fudging stuff for their Q1 earnings and their current outlook right now. And I think that could be a really nasty period. I think we probably sell off into it a little bit. And I also think that what this bank situation does for a lot of companies who've been doing death by 1,000 cuts as it relates to 2023 outlooks, I think it gives them a mulligan to actually maybe go out there, take down the guidance, and maybe that's the thing that listen, what bugs me about the market right here, and I totally respect what Carter said, and Carter actually had a really nice call from the February highs that the S&P the S&P was going to come in, that the NASDAQ was going to come in, and they've given back a lot of their gains from the highs in the year. I just think we are going to be retesting those October lows in the not so distant future.
All right.
Another one, October lows, baby. October lows. All right, everybody's convinced. That's awesome. Next one up here, I think we're starting to see all the Fed's work to come to fruition.
Do you, especially during these times? I mean, you've been negative. You've shared that consistent view with us and our viewers for months. Did the events of the last week make you more so?
Yeah, I think so. I think from our standpoint, we've been pretty patient in our defensive position. We watched rates go higher. We saw the multiple contract.
Before we get into this, there was a comment that kind of I thought was worth addressing that I saw in this video. It says, damage is done, but Fed's not going to stop raising rates. He's not stopping until 2%, as he said. Never said that. And that is sad because that comment got so many likes. And I'm like, that's such misinformation, man. Holy smokes, man. It's the blind leading the blind out here. I'm like, that Jay Powell never said we're going to keep raising rates all the way until we're under 2% or to 2%. He never said that, okay? They're going to remain in a more elevated manner in terms of rates until we get to that 2% range rate. But he never said we're going to keep raising rates. We could easily stop raising rates now, in a month from now, something like that, and then just maintain rates, even potentially cut rates as inflation goes down, if that's something they decide to do. And that depends on about a million different factors. But that man never said that we're just going to keep raising rates nonstop until we're 2% inflation. Never, okay? So, nonetheless, folks, don't believe everything you read out there. That's all I'll say about that, man. And I think about how much stuff happens on social media and Instagram, Twitter, YouTube, whatever, and people just see a comment and they're like, "Oh yeah, that's what Jerome Powell said," and then this person spreads it to this person and this person spreads it to this person. It's like, no, that was never the situation. That's not the situation.
And we started to see that flow into that negativity with regards to earnings. Earnings have come down about 11%. So we think that started, but this operates in long lags. So we have been a little bit antsy with regards to the fact that this has gone a little bit longer, and we think there's a reason for it, right? The reason has been there was so much liquidity put into the system. There were these additional facilities put in place which kind of elongated that liquidity in these businesses where they didn't really have that judgment day, and I think we're really starting to see all of that work the Fed do come to fruition.
So what does that mean then for if you're a little more net negative than you were before, where do you think stocks are going then from here?
I think what I would say is we're not at the end, we're at the beginning of the end. So what we're seeing here is a situation where...
The beginning of the end of the pullback? Or the beginning of the end of what?
The beginning of the end of where we can start getting a little bit more excited about putting money to work.
Okay.
I think what we're seeing is the market is realizing that all of that activity that the Fed has put in such a quick fashion is really creating...
See, this is the issue. This is the issue. All these guys are addicted to this, a hope of 3,600, or if there's an orderly sell-off, 3,600, 3,400 could make us more aggressive, right? And it's just they're so addicted to this. I got to get the market under 3,600, and it's just what are we doing here, man? And these guys wonder why they can't even keep up with the market returns, over a 5-10 year span. It's because of this mentality. That is such a bad mentality to have in the market, man. It's not even funny.
We
can all hope for everything. I could say the same thing. When the S&P gets to 3,000 or 2,800, that could make me more aggressive. Like, what are we talking about here?
Of where we can start getting a little bit more excited about putting money to work.
Okay.
I think what we're seeing is the market is realizing that all of that activity that the Fed has put in such a quick fashion is really creating breakage in the system. And so we saw that specifically within the banks, which we think are the things that are providing the liquidity and the acceleration with regards to growth. And as they start to have problems, we start to think that that'll manifest itself in other places within the economy.
So that leads me to the Fed, right? What do you think the Fed's going to do next week? I almost don't care like what you think they should do. What do you think they're going to do? Because that's ultimately what matters. We all have opinions. They don't matter.
So I'll answer it in two ways. So the first thing is, I think right now the market's like a coin flip, whether it's 25 or 0. I think in reality, it doesn't really matter. I think the damage is done. This is the situation where the guy at the bar has eight shots of tequila. And you know what? Like, having a bunch of coffee or stopping to drink the tequila doesn't matter. The damage is done. We're going to start to see...
It's funny because I was at the restaurant with my neighbor yesterday, and there was somebody that was so drunk at the bar they couldn't even like sit up at the chair, and they actually fell over, man. Oh gosh, that was quite a show. So funny analogy after that situation yesterday.
In the economy, and I think despite the fact that even if the Fed pauses, what has happened, the damage has already been done.
But then, well, it has to run its course. I mean, what reverses if they stop? If they don't hike anymore, doesn't that lessen the damage? Even if some of it's already been done, it doesn't take the next step of making it worse.
No, because I think what we'll start to see is some real damage within underlying businesses themselves. So some of these businesses that really shouldn't be operating at a level where the cost of funds is at this level have to start to come down in value and have to start going out of business. And so we started to see some of these people that were offsides getting caught offsides, and I think we're going to see more of it. You never see a situation where you have this type of breakage in isolation. It's something that's going to fester throughout the rest of the economy. And so for that reason, I think you still need to be defensive. You still need to sit on cash, and you don't want to be aggressive with regards to adding equity exposure.
Let me just let everybody know that the official release...
So you hear what that gentleman just said? Sit on cash right now. That's what he's saying, basically, right? And that's what a lot of these Wall Streeters have been doing and want to do, right? And that's exactly the reason it's hard to get this market to have this next huge sell-off without some sort of catalyst to get it there. Because so many of these Wall Streeters already positioned so heavy into treasuries and cash, right? Over the last, let's call it 6 to 9 months. And they sold out of stocks in mass, obviously, throughout 2022, all the way almost till the end, right? We kind of bottomed out the market October, November. But that's why, you know what I mean? Because they're so cash heavy, they're so treasuries heavy right now. And, you're going to need to get folks that are even long-term investors to sell, and that's just not happening because those folks, it doesn't matter what happens in the market. They're just going to look at it as a buying opportunity. So you're on a no-win when it comes to that.
Of the Lefebvre reporting is now out. That consortium of banks, really what it is, all of the big names on Wall Street, plus the likes of BNY Mellon and PNC, State Street, Truist, U.S. Bank, and again, along with all of the heavyweights. And you can see on the screen here the amount of money. We're talking about uninsured deposits totaling $30 billion into First Republic, trying to at least, give a little bit of a rescue here and ease some of the concerns, soothe the markets, however you want to characterize it. Now that the release is out, the stock is back on the move higher. If we can show an intraday of First Republic, when news of this broke with David, the stock obviously took a big leap up. Then it dipped negative for just a second, or right on the line, and it's on the way back up by some 12%. So we'll keep our eyes there. There's nothing to say, by the way, that there's more, that there are other banks that are going to somehow have a major problem.
No, that's pure speculation. I think from our standpoint, it just demonstrates the fact that there are problems within the economy that are starting to manifest themselves. And some of those we can anticipate. So these are businesses that are dependent on liquidity. These are businesses that are running out of money. These are businesses that are trading at higher multiples. Those are the places that we think are going to have the most problems. But I think the fact of the matter is that we don't want to speculate. We want to talk specifically about facts. And the facts facts are the Fed's raised rates dramatically. Banks are going to be raising their credit standards. Liquidity is going to be drying up, and that's going to be negative for equities.
So you want to be then more in cash than you even have been in the past, which, I mean, you've had the most cash, I think, than you've ever had.
That's right. So I think we're pretty happy with where we're positioned. We're pretty happy that the market is coming to us, and we're looking where the opportunities are to deploy that cash.
What? What are we talking about here? Let's see. NASDAQ's up 15% this year so far. We haven't even completed 3 months this year, right? Countless stocks are, 50% up, 100% up, 150% up in the big tech field. It depends on what your outlook is, but I'm like, I don't know. I wouldn't be so happy just to be sitting on cash watching, these stocks skyrocket that are easy long-term holds. It's like, how hard is it to hold Tesla stock long-term? NVIDIA, Meta. Like, these aren't even hard stocks to hold, AMD. Like, just hold them long-term. And they dip huge, buy them. Dollar cost average. Do the whole game. And, to be positioned all cash while you watch those sorts of companies of that quality, that's A caliber companies. You're missing out on 50%, 100%, 150% gains. Okay, whatever. If he doesn't have his, investors on his tail, I guess he can be happy. That's all that matters.
Your head gets comfortable on the pillow at night. I hear you. What turns you more aggressive? What's the one thing you're looking for?
Real pain in the market. The market coming down significantly, where values we think prices are more equipped to the values that we put on them. So I'm thinking, probably 10 to 20%, we should start looking to put money into work. That's kind of 3,600s where we start looking.
You think we could get another 20%?
I do.
Well, all right, well, we'll see. We'll talk to you.
Okay.
Again, I know we will. That's Chris Toomey.
Yeah, it's just the issue is you have so many of these Wall Streeters that are already positioned so heavy in cash. So many of them are so convinced we're getting this 20% drop. And it's just like, as time's ticking on here, it's becoming more and more unrealistic. And as you get a bank runs and all that scenario, and then the Fed to come backstop it, it just gets harder and harder to sell that dream of like getting the market down another 20%. If it happens, I'm more than welcome. You know what my S-Dow calls are going to be worth? Oh my gosh, it'd be ridiculous. Okay, so and the deals out there all over the place. So I hope it happens. It's just it's going to be tough sledding to kind of get it there. Appreciate everybody joining me as always. Make sure you join us in the Patreon. You get to support the channel, plus you get to see all the moves I'm making in the market. It's going to be a pinned comment if you're looking to apply to join my private stock group, the private wealth group. That will be in the description area to apply to join us in there, and have a great day.